in life. But what I learned from my father was a real estate developer. The thing he emphasized to me the most was income.
My guest today is Steve Selengut. Steve is the income independence coach, an author, and a successful investor who has a different take on retirement finances. Steve, welcome to the show.
Thank you, Gabe. Glad to be here.
Steve, you are known as the income independence coach. What does income independence mean?
Okay. That's the ability to say that it doesn't really matter to you whether the stock market goes up or down, whether interest rates go up or down. It will have no negative effect on the income that your portfolio is generating. And in fact, it will help you grow that income and your capital that produces the income even faster.
Steve, I think you have a very interesting history where back in the late 70s, you already built up your investments so that they provided many times your actual active income. Tell us a little bit more about your history and how did you stumble on this approach?
Stumble. Well, I was a fortunate child. I selected my parents well, and I didn't have any of the normal problems people have with student loans and stuff like that. So I have to say I had a head start in life. But what I learned from my father was a real estate developer. The thing he emphasized to me the most was income, because in his real estate, he was vertically integrated, if you're familiar with that term. He owned a lumber yard. He bought the property. He built the house. He had rental properties. He had the insurance on the properties. He took back the mortgages. So he emphasized to me that it wasn't necessarily the value of the properties or the value of the land that I owned that lets you and your brother and mother live this style. It's the income that I have coming in every month. Because I have more money coming in every month than I spend, I can put enough away to buy another property and continue to grow my income. So he made that very clear to me, and he made me put away, you have odd jobs as a kid, like mowing lawns and teaching people how to water ski and things such as that. He made me put away 25% of it. And when I was 25, and this is the true story, at my birthday celebration, he plopped this legal size manila envelope down in front of me and said, "Here, it's your turn now." And I opened it up, and a lot of your listeners probably have never even seen a stock certificate, but it was full of stock certificates. It had General Motors, IBM, Sears, da. And this had all come about from two sources: the money that I had given him to put away all those years before, and what I didn't pay on a college education because I didn't go to an Ivy League school like my brother did. So I didn't work hard. I didn't create anything, but I did enough, and I understood enough that I got this in my lap. And I went to a broker, and she and I studied the securities. She told me what she thought about them. They all produced income. They were all dividend payers. And I studied their charts, and I saw that they went up and down in price, not predictably, but certainly opportunities were there that, yeah, I could have sold it here and bought it again here. It may have been 6 months later, or I could buy it here, and 6 months later I could have sold it there. So I started, at the same time, parallel story. I was working in a life insurance company in Manhattan, and I was in the pension investment department. And we were in the process of converting people from a record-keeping system on the defined contribution plan. That's almost like a profit-sharing plan, and it's like a 401k, a matching thing and all. We had much less ability to choose anything in those days. But I was able to look inside the portfolio, and I was happy to see that a lot of the securities I owned were in their portfolio as well. But what I didn't understand, and when I spoke to this investment manager on a flight to, I think it was a flight out to Boeing, and in my first book, I call it the story of Boeing, the Boeing story that put on this big light bulb. But we were talking, I said, why? Why do you have millions of dollars, much more than normal, in Boeing stock when it's not a huge dividend payer and you got a big profit in it? Why don't you sell it or sell some of it and move it around? And he told me, here's a fact of investment life for you, Steve, that you're going to have to understand. And the big boys put money in stocks because, and the because in this case is that Boeing is one of our biggest insurance customers. And they like to see us own a lot of their stock in our defined contribution plan. So that's when that light bulb went off, and the hostesses ran over to see if everything was all right, just kidding. And I said, aha, I am always going to take profits. I'm going to set a target for everything I own. When it gets to that target, because it's no longer just economics, it's not supply and demand in the marketplace, it's politics back there too. So I'm going to take my profits. I'm going to find something else. If this thing goes back down into my buying range, I'll buy it again and do it all over again. And that's what I did. And and with my first profit, Rita, my broker, said, you should start to put something away for income, for future income. I said, okay, what do we do? She says, let's try municipal bonds. And I bought a Fort Pierce, Florida, 4% coupon municipal bond. You're familiar with coupons. There used to be coupon bonds. My father, that was the only investment he ever made because he could just clip it off, take it to the bank. But they were negotiable. Whoever, they're called bearer bonds. Whoever had them in their hand, he was the owner. There was no registration. So imagine that a guy who wants to avoid taxes would invest in bearer bonds. That was it. But they don't have them anymore, I don't think. So anyway, that's when I first started putting something away. From every profit, I'd take 25% and I'd start to build an income portfolio on the side. So the dividends were coming in, one stream of income. I had the capital gains, another stream of income, and I had some interest coming in on the income side. So that's how it started. So by the time I got to be, by 1979, I think I was 34 years old, my income from running that portfolio, and the size of that portfolio was, getting close to seven figures in 1979.
That was a lot of money in 1979.
Yeah. Was literally 5 times what I was making with this insurance company. About that same time, my wife figured out that I was never going to really make a lot of money at that insurance company because I just didn't know how to suck up to superiors properly. I didn't run around, on their tail say, "Can I help you?" The type of stuff in corporations that were important. So that pretty much wrote the picture for me. Okay, I got some friends with money. I'll see if I can do for them what I did for me. And 2 guys said okay. So on the day after I vested for the pension plan with this company, you had to be there 12 years. The day after I vested, I left and I started my own company with these
Steve,
2 guys.
so just to summarize, if I heard you correctly, you started investing in stocks and then you sold stocks whenever they hit a certain target that you had, a profit margin, and you used the earnings or the capital gains from those stocks and you reinvested it into cash flowing municipal bonds and other similar cash flowing type investments.
25% of every profit went into an income, starting the income side of your asset allocation. A lot of people have more than 2 classes of investments. I have 2. I have income purpose investments and growth purpose investments, meaning my primary objective is in this one is to get more income. My primary objective in this one is to produce capital gains. And in my way of looking at things, everything I buy is always for sale at a profit. And that target profit will vary with where we are in the market cycle or where we are in the interest rate cycle. Not necessarily and at a target price, and the target price will vary. If, like when we were very low, I don't know if it was January 3rd or thereabouts in 22, actually, that bad year 22, that the S&P reached its last all-time high before this current spurt. So right now, we're literally more than 2 years from that time, and we're probably up a total of maybe 3% over that 2-year period in the stock market. The Dow is done a little bit better. The NASDAQ is still below where it was in November of 21 by a few percentage points. So it hasn't been a great year. It hasn't been a great 2-year, 3-year period, but it's been a great year this year, except for income generating securities. I keep leading myself into another chapter. I'm sorry, but most people think of income securities as very boring. A bond, duh, blah, no excitement there. You buy this, it pays every 6 months, you get some interest. It's not a lot of interest. Interest rates are up, so all my old bonds are now down in price, that type of thing, and they don't like that. Some people can talk them into selling them when they're down because they're so terrible, but what they don't see is the opportunity in the income focused side of their portfolio. And I thrive on that. I mean, now I'm almost 80 years old, right? I'm only a year and a couple months away from being 80. And so 65% of my portfolio is in income purpose securities. And I see that right now, closed-end funds, which you could ask me about later. Closed-end funds right now, these are diversified portfolios of bonds or stocks, depending on which ones you happen to be buying. Both are right now yielding in the 9 to 10% range on average, like an average 100 different closed-end funds in each of those categories yielding 9% and 10% respectively, the income being a little bit higher than the stocks. So what I'm getting at is in my portfolios, I have every possible equity you could probably imagine that you've talked about, that the talking heads talk about, that Wall Street gets excited about. They're all inside these funds. And I also have corporate paper, mortgages, REITs, preferred stocks, notes, liens, in convertible securities as well, in my income side of my portfolio, yielding that much money. So I get to the point in life where, this portfolio is generating 10% on market value right now. It's not a bad place to be. And it's a whole different kind of security, but it's a whole different kind of security, but it's the same as everybody else is investing in with much more agita than I have.
So let's rewind it a little bit.
I'm sorry.
Yeah, when that's okay. No, it's
I went
all
too
good.
far, but that's how I got there. I used income production, and then from that point on, I started doing that for other people. I know you've spoken to others who have emphasized that they don't want to sell securities for that 4% they're going to live on of their market value. And that's exactly what I did. I had 110 million under management when I sold my practice last May, and I had 150 clients, and there wasn't one of them that wasn't making more than they needed to spend in retirement, and it was a whole lot more than 4%.
That's incredible. So let's
So,
get back to the fact. I remember in your example, you buy equities or in assets, they appreciate, you sell them, you invest it in a bond or some similar cash flow producing asset. What is the difference between, say, buying a bond that yields 4% versus just selling 4% of my portfolio? Because that's the traditional advice you get from financial planners, is just have this gigantic, pile of mutual funds, and when you retire,
well,
just sell 4% every year.
let let's back up and talk about the difference between market value and productive capital. Let's say you have $100,000 in bonds or stocks or whatever they're in, and you've invested $100,000, and the yield on your portfolio, let's say in the stock market, well, in any advisory type portfolio right now, that yield is probably about 3% at the max. In most of the model portfolios, and particularly, it's much less. Okay. But they have to sell something to get you your 4% each year. And they're charging you 1.5% to manage your money. So that's 5.5% that your portfolio has to gain in market value to break even. But even if it does break even, they still are selling things. They usually just sell the ones that are down, the losers. So they're depleting capital anyway, because they reinvest all their earnings, what little earnings there are. So you get to the end of, so let's say you have 100,000 like that, you're going to have to deplete capital to get to the 4%, because you've got 3% yield, you got 4% need, and you're paying a 1.5 in fees. So let's say instead, well, let's say the market value of that fund goes up to 150,000. Now it's paying even less than 3% on market value, because the prices have gone up, but the dividends haven't changed, right? So the same income is coming in. You're taking more money because your 4% is now of 150,000, not of 100,000, and your fees have gone up because they go up with market value. Okay, so you're going backwards. You have to deplete capital. Okay, so let's take the same thing. You got $100,000 and it's spread amongst 200 securities. Half of them are income CEFs, closed-end funds. Half of them are equity closed-end funds. You've got the same exposures in everything, but the yield is 10%. And you could do this yourself and not pay any fee at all. But if you go to my old company and you're paying 1.3% fee, you still are making enough to reinvest that income. Now, the market value, if the market value climbs to 150,000, your yields are going down, but the income is still the same. So you're still getting the same amount, and it's probably still enough, even though your 4% is gone. So that's the way it is, and you're reinvesting more than half of your income. So you're growing your income. And if the market has gone up like that, think of how many profits you've been able to take. The market's gone up 50%. You've probably taken at least another 10% in profits, at least, probably less. In 2021, in my firm, we started the year with $90 million under management, roughly. And during 2021, we generated $7 million in distribution income from these closed-end funds, and an additional $7 million in capital gains. My broker and I there were several months in which we were literally taking $30,000 a day in profits. It was just incredible.
Yeah, just to put some numbers to it. So you're saying 7 plus 7 is 14 on 90 million. So that's a gain of like 16 or 17%.
Yeah, and it's realized. It's not a market value gain. It's a realized in the old pocket. You can reinvest it. You can take a trip around the world with it. It's yours. Market value, you can't spend. You can't spend it. You got to sell something to spend it. And I like to sell things at profits, not at losses. This year, I've already sold, and I have not taken big profits. I'm not saying, oh, I made 40% on this or 30% on that. I don't make money like that. I make 3%, 4%, 5%, but in bits and pieces, set up. In my 3 personal portfolios this year, I've made $18,000 in capital gains already. this year, January. So it's a different approach. You do pay taxes, but if you make $50,000 and you have to pay 30% in taxes, you still got 35 left, right? That you didn't have before. It's new money. It's like your rich uncle sending you a check. This month he sent me $18,000. Next month he might be cheap. I don't know. It might be less. But but that's the way I operate a portfolio. I line up diversified. Closed-end funds are the same types as mutual funds and ETFs. The difference is their purpose and how they operate. The two popular ones, the mutual funds and ETFs, their goal in life is to grow their numbers, their market value. That's what they want to do. They pay out some. There are very few ETFs that pay as much as 6%. There are some, certainly. I invest in 8 different ETFs that pay over 10%. But the average yield is probably more like 3 or 4. And the same is true of mutual funds. The purpose of these managers is to grow their market value. In ETFs, they actually have a choice of when to buy and when to sell, and they usually are passive anyway, so they're just there and they just fluctuate, right? In mutual funds, the distinction is that they're really not managed when you need to have them managed, because people are buying and selling shares directly from the fund. And when you say, I want to sell my $1 million in this fund, they have to sell securities to get you your $1 million. Just like if you give them $1 million, they go out and buy securities. So the closed-end fund is different. It's totally different. First off, any income it makes, whether by capital gains, by premiums on selling options, whatever, it has to pay out 95% of that to keep its tax status. It's called a pass-through trust. That's what they all are. So they can't possibly have the objective of growing their portfolio if they have to give away 95% of the income. How big would Amazon be today if it gave away 95% of its income, over the years? So that's the difference. It's a distinction that's very important, because that affords them the right. It encourages them to pay out more income to their shareholders, and that's what they do. Okay. The other thing, they're tradable during the day, just like the ETFs. They're not like the mutual funds that trade overnight. And the final thing is, when there's a COVID 30% drop in the market, they don't have to sell shares like a mutual fund manager does, because the portfolio is over here. The common stock is over here. It goes less, just like a normal stock. It doesn't have any impact on what the manager does. The manager's not selling when the market goes down. He's buying, like I am. And when the market goes up, he's not just go, wow, I'm getting rich. He's selling. So that's the distinction between the two. A closed-end fund is a lot like a stock. When you buy a stock, how often do you think you've bought it at its book value?
And its book value, almost never.
Absolutely never, right? But one of the big criticisms of closed-end funds is sometimes it sells at a premium to its net asset value. Net asset value, book value are the same thing. And sometimes it sells at a discount, and the net asset value varies irrespective of what's going on with the price. That's a big concern. People are having a lot of trouble wrapping their head around that when they start investing in closed-end funds. I pretty much ignore it, because I treat them just like I used to treat my big board stocks. It's just a number. You buy it, set a target, and then you sell it. So anyway.
And can you give us some examples of some ticker symbols if one of our listeners wants to go and check out one of these funds?
I can
What's
tell
the
them
first one that pops to you?
I still consider myself pretty much a fiduciary and a professional manager. And you'll notice that not too many of us give individual symbols because it's like a tip or a suggestion or a recommendation. So I won't do that. But there are many closed-end fund websites that you can go to. And the one I use for all my research is one called CEF Connect, closedendfundconnect.com. And you can screen those in any way from municipal bonds through common stocks. You can sort them in any way you like, by price, by yield, I guess I have to say by leverage. You know what leverage is?
Absolutely, yeah.
Let
Investing with borrowed money, right?
With borrowed money. And is that something that's prevalent in the world?
Not really. People who do real estate, most people in real estate naturally take out a mortgage and kind of leverage, but I think when
Right.
it comes to stocks and mutual funds, less so.
Right. In ETFs and mutual funds, they do not. But what about the corporations themselves that the mutual funds own?
I would
How
say
many?
most corporations have debt on their
Right.
books.
Exactly. One of the biggest quality indicators you can use on a common stock is the debt to equity ratio. Right. So another distinction of the closed-end fund is that they can borrow up to 50% of their net of their assets. And instead of borrowing, like, let's say Walmart's going to borrow $300 million to build another store, right? So that it can generate more income, blah, blah, blah. A closed-end fund manager is going to borrow X amount of dollars for the last 12 years, he could do it at almost nothing, but now it's 5%. So he can borrow money at 5% and reinvest it in securities that are paying more than 5%. He's an individual manager. He's a person like you and I. He's not going to borrow money at 5% unless he can make more than 5%, right? He's
Right.
going to buy bonds. They may be not a AAA bonds, but no real managers buy AAA bonds anyway. Most managers buy the lower, not they don't buy D-rated, but they buy the middle-rated bonds. The only thing they get for AAA is they pay some insurance, and the yield is lower. That's all they get.
Yeah.
So that's what they're doing. So they'll borrow money and reinvest it. The shorter term they can do it, the easier they can turn it back over again and again and again. And when interest rates are low, they certainly don't buy any long-term paper. So right now, think about all those 2, 1, 2, and 3% notes and bonds and securities that are maturing that they now can reinvest at 5 and 6 and 7%. And they'll take a little longer chunk. They won't take the 5-year loan. They'll take the 10-year loan, So this is a good time for these people, not a bad time with interest rates up a little bit. So that's the story. You're using a totally different vehicle, a vehicle that instead of taking that $300-400 million and investing it in a new piece of property or a store, they're putting it into more securities and generating more income, which are not related to our share prices. It's just more income. So that's how they can pay 8, 9, 10% when the regular companies are not. They also do preferred stock. Same thing. Same principle. They sell preferred stock over just like anybody else does. So they raise money differently than the other two types of funds. And that gives them the advantage. Leverage is an advantage. We wouldn't have a real estate industry if there wasn't for leverage. It's about. I did a podcast a month or so ago with a real estate guy, and we were talking about how what I do is very similar to what they do with properties, rental properties. So if you look at all my closed-end funds are really apartments that are paying me rent every month, and CEFs do pay monthly, like ETFs do too. So, they're just the same thing. And what the good thing about them is that the money's coming in, and the net worth of the property, the market value of the property isn't nearly as important to you. The difference I don't have nearly the overhead with a closed-end fund as I would with an apartment or an apartment building. There's no, there's no mortgage, there's no interest, there's no insurance, blah, blah, blah. So it's a lot easier. By the same token, again, a parallel with real estate is it's like flipping houses on a large scale. These people buy the house, they give it a paint job, and they sell it. I buy it, I let it sit there. If it goes up, I sell it. So it's more similar to real estate with the leverage aspect than it is.
And if somebody wants to start looking more closely at this idea of income-focused retirement investing, what are some of the basic principles they need to be aware of?
Income focused is just that. You've got it. And so many people say when they come into after they read the book, after they read that, and they come into the Facebook group and they say some of the conversations, it's like, I'm getting a headache from trying to wrap my head around this idea that the market value is less important to me than the growth and doing things that'll grow my income. But as we get close to retirement or just thinking about building income, or the old FIRE movement, getting out of this whole rat race earlier, these things are the ideal solution to it. Well, what you have to do is do that. You have to go out and do the research, find a set of securities that you understand in the closed-end fund arena, and it's not difficult. I every month I prepare a new set of selection universes, and they're available to people. And in the book I go through what I call the four pillars of risk minimization. And you can do the same thing when you go to Closed End Fund Connect and you look inside these closed end funds that you're thinking of buying. You look at the quality, and we can't measure quality by debt to equity ratio really, or price earnings ratio or anything like that, but we sure can look at the yield over the last 5 years and how the distributions have fared during 12 years of slowly reducing interest rates, and now after 2 years of rising interest rates. And in your mind, you should be able to picture what an interest rate sensitive security would be going up in the first scenario and down in the second scenario. So you see if it reacted like it should. You look at its volatility. Most people hate volatility in the stock market. In this area, you love volatility. We sell out of love here. We don't sell out of hate. Most people sell out of hate. We sell out of love. So when we see that market going up and down, we know we're going to take some profits. We're going to pick up some things lower when it goes down, and we don't care anymore what their names are because we've got 100 interchangeable parts. We've vetted them all for quality. But back to quality, they got it for me, and in the book spells out these things. Quality, they've got to be at least 5 years old. I have to look at a history. They have to have at least 50 companies inside, meaning I'm not going to buy an equity closed-end fund that has less than 50 companies inside, or more than half of it is in the top 10. The average that all of the ones I invest in have probably 200 or more different stocks in them on the equity side, and a larger number on the fixed side, probably an average of 3. And in the tax-free municipal bond side, which is really a really good thing when people think about the hassle of investing in individual bonds with the markups and the accrued interest situations and all that disappears with closed-end funds. You're buying a stock and all the income is tax-free. I mean, It's like nirvana for that type of an investor. Anyway, so where was I?
And when you say it's tax free, is it because municipal bonds have a special tax status?
Municipal bonds are tax free.
Oh, I did not know
Yeah,
that.
federally
Huh.
tax free. Yeah, it's that's what I like. I think I mentioned before. My first security was a tax-free municipal bond from Fort Pierce, Florida, 4% coupon. Yeah, I mean, there's only been one major failure in a municipal bond in recent history, and that have you ever heard of the Whoops fiasco?
No.
WHOOPS. It was back in it's got to be 25 years ago. Washington Public Power, and I think I can't swear. It's just, like I said, it was 25 years ago, but I think they were in the midst of built. They had borrowed all this money. They sold municipal bonds, and all this money was borrowed for a nuclear energy project.
Mhm.
And for some reason, it either terminated or failed, or they just, that got legislated that it couldn't be complete. Something happened, and they had they didn't stop paying the interest. I had a client whose entire portfolio was in that, and he's just pretty much lost everything. He wasn't my client. He came to me after that. Sorry, I didn't mean to say that because I never really bought individual bonds. I waited until I used to use bond trusts, unit trusts. Are you familiar with those? Corporate
No.
unit trusts. They were a good popular item, and one of the good things about them, you got the interest, and you got it monthly instead of every 6 months because they were laddered properly and everything. And they paid you back principal as well as interest. So as the bonds matured, you got back your principal. Return of capital, which a lot of people are offended with in closed-end funds because they also get return of capital occasionally. But it's very common in bonds, annuities, and mortgages. They all pay return of capital. So it's not the only thing about return of capital that you have to think about is don't spend it because it's not income, right? You got to reinvest that, buddy. That's what you have, as long as you understand that. But yeah, um, municipal bonds, 300 or 400 different municipal bonds in one closed-end fund, and there are states where you would that have like California and New York and New Jersey, the primary ones, where you can buy um, closed-end fund that just has Jersey bonds or just New York or California bonds in it. So you get federal tax-free and state tax-free in those jurisdictions. I would caution people, though, not to set up a whole portfolio of just one state, because you'll remember that New York has had its crises and California has had theirs. And why New Jersey hasn't had one, I'll never know.
Mm.
Being a New Jerseyan, I can say that. I'm a native. So yes, that's a big thing for wealthy people with large incomes, $1 million incomes. Tax-free municipal bonds are a big item on their balance sheets, on their investment portfolios. And you can do all of those in closed-end funds without any of the hassles, without any of the concerns.
And I see your book over your shoulder behind you. Retirement Money Secrets. Tell us about the book.
Okay, well, the book is designed. It's kind of like my last hurrah, after having sold the business or knowing I was selling the business, and I was then going to have to do something with myself and become a coach. So I decided I would start helping people do what I did at whatever age. Where was I at 25? Where was I at 45? And get them to that point where they realize how important income is in the equation. So the book goes through it with my conversation with people that we met on a Viking River cruise starting in Amsterdam, you know, and it's some kind of real and kind of not, that type of thing. So we're starting to we have a conversation, and the woman was lamenting about how much mutual fund she had to sell to pay for the trip. And so I started talking, and we talked and talked, and the and it was like a huge Q&A conversation between this couple and I, and what he could do to change his portfolio so that when 2 years later, we're planning on taking this trip to Japan together, why he wouldn't have to pay a nickel out of he would have to sell a nickel's worth of his mutual funds to pay for this trip, because we'll have him in a position that his portfolio would take care of it. So that's basically how it happened. So we go through the quality I was just talking about, and we spell out the 5 or 6 different tests of quality. We talked about diversification. Most people have too few securities. They have so much invested in one security because they fall in love. Or they came out of a corporate environment and most of their portfolio is the stock of that company. And they love it, and who blames them? But it's only paying 1.5% in income. You got to cut the cord. You got to produce more income. So we look at diversification in my coaching business, and maybe this will strike a chord with somebody who's listening. That I've dealt with people with millions of dollars, and $1 million of it might be in just two securities.
Wow.
And I say to them, and maybe it's a common stock that they just have $500,000 in. I said, what if the board of directors is flying in a plane and they have a Payne Stewart situation? You know what that is? Payne Stewart was a professional golfer, and he was in a private jet, and for some reason the oxygen flow stopped and the plane just went until it ran out of gas. And I said, what if that happens to your company? The chief executive and the board of directors goes down in flames. What's going to happen to the price, and when is it going to recover? Is it going to recover? And you're dipping out of that for your 4%. You're selling a few shares every month. You can't have that much risk in one thing. So we talk about risk levels, diversification, no more than 5% of your portfolio in anything, period. In my portfolio, which is substantial, not as much as some of the people I looked at, but it's okay. I can live on it. The most I have in any one security is 2.5% in anything,
Wow.
So that's the type of thing. That's the diversification. And then there's diversifications by sector. Some people are very heavy in the tech sector right now, and it's a very low paying sector income wise, things like that, so there's tech, there's health, there's energy, there's retail. Every sector should be represented, because the market, not only is there a market cycle, there's also sector cycles. You want to be in a position where you're going to take advantage of everything that happens. I take diversification from a defensive method, a risk preventer defensively. I make it an offensive weapon for capital gains. I own everything. Not a lot of everything, but a little of everything. So if for some reason or another a healthcare company develops a new life-saving technique and all healthcare stocks go up, my healthcare closed-end funds are going to go up, and I'm going to take profits. And by the time I buy them back, I'm going to get those profits a second time in the dividends that they pay at the end of the year. Yeah, it's so that's diversification. Everything I own pays income, and I think, and I set my income goals very high. On the income purpose side, it's 6%. I won't own anything that doesn't pay me at least 6%. On the equity side, I won't buy anything that doesn't pay me at least 5%. And with the tax-free municipals, I won't own anything that doesn't pay at least 4%. So I eliminate, I'd say they're roughly 500 closed-end funds compared to 50,000 ETFs and maybe 500,000 different mutual funds, just 500. And there aren't in many shares, so they're very volatile, which I like. So I have about 240 that I own.
Amazing.
And in 3 different portfolios, but that's the diversification. Profit taking is the 4th pillar of risk minimization. Everybody who's listening, I'm sure, has experienced the heartbreak of seeing a profit disappear overnight. When the market crashes, there's something goes on. In 9/11, a 9/11 type bump. Those types of things happen. And I said in my first book, I said that most unrealized profits wind up as realized losses on a tax return eventually. They hold on, it starts to go down. Oh no, it's coming back up, it's going to come back. And finally, they get so fed up that they just hate it and they sell it. Or it does go under, one or the other. But profits are very important. 2 other items that are covered in the book. I also, the closed-end funds, of course, are gone through in detail because I use closed-end funds and a handful of ETFs, 8 of them, in my portfolios, in my programs that I teach, because of the income and because of the flexibility and ease of trading and so on. But the 2 other things that the book emphasizes are A, you've got to appreciate, you've got to realize and understand that in the investing environment in securities is a cyclical beast. It's not going to always go up. It's always going to go down, and then it's going to come back up. There's never been one that hasn't been replaced by the other. And you can't possibly predict it. And no matter who tells you what, with what data they're telling you, they know this is going to happen, that's going to happen. There is no KNOW and no LOVE in investing. Uncertainty is normalcy. So get the idea. You set targets for profits. You have an idea of a trading range for all those different securities you're looking at, and you don't want to buy it when it's at the top of its trading range. It doesn't make sense, does it? Particularly closed-end funds, because they have a very narrow trading range. Like between $10 and $20 a share, for example. And if it's up near 20, you wait, because there's so many more to choose from. So that's, there's a market cycle, and and it's easy to figure out where you are, relatively speaking. Clearly, you can look at the S&P and see that the stock market is near an all-time high, or at an all-time high, actually, as of Friday. And same with the Dow. NASDAQ, not quite. But for individual securities, it'll vary between the type of security it is. If it's if it's a secure portfolio of bonds, it's going to be down near the bottom. It's going to be up from where it was over the last 12 months, but it's still going to be way below where it was when interest rates were 0. So you know where it is in the cycle. So you place your buying and selling targets on that. So that's the one thing. And the final thing is the words that you just mentioned, the income focus. If you really want to be prepared, if you really want to fire, if you really want to pay those kids education without dipping into your principal, you got to have income. You got to start focusing on developing income. And with the medium of closed-end funds, you can develop significant amounts of income while still having a portfolio, a 40-year-old, a 30-year-old, a 50-year-old, with 70% in the stock market, and still be generating 9% income with closed-end funds. So that pretty much sums up what the book is all about. A lot of Q&A, stuff like that.
So Steve, where can people reach out to you? Where can people learn more?
I have a website called theincomecoach.net, and it spells out what I do. It talks about some of the principles that you and I have just spoken about. It talks about coaching services that I provide. I'll talk to you. I'm not that $1,500 an hour type guy. I want to talk to as many people as possible. I'm not really in this to make a fortune. there to help. And I introduce you to the Facebook groups that I manage. So I think we've covered a lot of what's in the book and what it's all about, to generate income in investing without focusing on the market value, without being quite so concerned about the ups and downs of the stock market and interest rates, how you can still sleep nights, knowing that your income is safe and actually that it's growing all the time.
I love your passion, and I can just the way you're speaking, and I can tell that you're definitely knowledgeable and passionate about it. So thanks very much for
Oh, you're
helping
welcome.
people, for educating
I
people, and for coming on the show.
I appreciate being here. I can't believe it went by that quickly. It was fun.
Yeah, thanks very
Enjoyed it.
much for joining us, and
Okay.
talk to you next time. Thank you.
Yes, sir. Take care.
Hey, thanks for joining us for another episode of the Money Seed Podcast. Please remember to click like and subscribe. It really helps spread the message to other investors, and it helps attract new viewers to the show. We appreciate your support. Thanks very much.